because, oh gosh. Hi guys, thank you for joining me in another video. I don't know about you, but we've been having a massive heat wave here in London and the humidity is real. So today I want to talk about whether we should be buying UK or not. So cue intro. The UK has been having a horrible time when it comes to global markets. In the last few years, we've had Brexit. It's undeniably had an impact on investments. So you all know I like to sprinkle a few facts out there. Between February and April, the UK economy shrunk by 25%. That's the same as the UK, well, not UK, the US and the Great Depression. You remember when people were jumping off buildings, right? It's not really been great in our global standing, and now the entire world has been affected by a pandemic. In March alone, we saw GDP slide down by 6%. What is GDP, by the way? GDP is the monetary value of what it costs to produce goods and services within a set period of time. And then in April, we lost 20% of our GDP. So let's put that into context. The most that we've ever lost in GDP was in March 2009, where we lost 1%. And then through the entire financial crisis, we lost 6%. So that gives you a little bit of perspective, if anything. Just think about it. GDP is now back at 2002 levels. Just think about that for a second. Let's think about 2002. Princess Anne died that year. Rio Ferdinand was the most expensive transfer over to Man United that year. What else? Only 50% of the UK had access to the internet in 2002. What was life even? As we live through this, our interest rates are well below inflation. Bank of England interest rates are at 0.1%. And that's the lowest that it's been ever since the bank opened in 1694. What? And then on top of that, the bank has bought 40% of our GDP through bonds by printing more money. So this all sounds quite dire, but how do we think about this as an investor? Well, central banks across developed markets have developed a swifter response in how tools have been used in the past to stimulate recovery. Economists this week reported a €750 billion EU recovery fund, and that with the ECB, the European Central Bank's buying of 1 trillion in bonds, they saved the day. Having said all that, Europe has been underperforming compared to the US in its recovery. Euro Stoxx 600 is down by 12% compared to the S&P, which was only down 4% since the 1st of January. In short, Europe is 4 times worse in delivering returns to the market and investors. The underperformance isn't just because of the virus. It's been going on since 2018. Why? Well, because of Trump, obviously. Trump has been pushing the America First agenda for a long time, and he has a tough stance on exports, and it's dampened the demand from Europe. For perspective, EU trades 45% of exports, and so is dependent on world trade and US policy. Then there's the pandemic, which has hit hard. Credit agencies are predicting that it will be 2022 before we reach the levels of output that we were pre-pandemic in 2019. There is one dominant factor that I want to talk about, and that is Germany converting to fiscal stimulus. And fiscal stimulus is when the government spends more or provides more tax breaks. And this creates a multiplier effect with domestic demand increasing because Germany is EU's largest economy. So when Germany rises, so does everyone naturally. And likewise, Germany is UK's second largest export partner, so we benefit as well. So the question is, should you buy UK or not? British shares at the moment are undeniably cheap, especially when aggregated and compared to the US or the EU. Dividend cuts and Brexit uncertainty has meant sentiments towards the FTSE are quite sour. Traditionally, stock buyers in the UK want a higher dividend yield. So this has created an opportunity to buy at a lower cost. It is a contrarian investing methodology, and sort of the herd approach isn't really existent at the moment because there's not really much interest in the market. So people following value strategies and contrarian investing will be loving it. Despite all this negativity around dividends, there is belief that there will be recovery. Yield hunters should know that the UK still offers some of the best dividend yields in Europe out there. There was a comment from Schroders that stated that PE ratios and dividend yields were down about 15 to 20% below the 15-year median. The price to earning ratio is typically used to determine how expensive a stock is at the outset and how much an investor needs to pay for each unit of earnings. And at these levels, the UK is currently trading at emerging market discount levels. So the question is, do we stick to the UK for passive incomes? There is a lot out there in the YouTube community about creating passive incomes from investing in dividend stocks, and the trend is generally towards the US stocks. I myself like UK stocks because there's no FX risk, and there's a great selection of UK companies here as well. For the most part, income investors tend to ignore the US because yields are half of that of the UK, so 4% against 2%. There are some gems out there for dividend payers in the US. For example, you've got Johnson & Johnson's, which have increased dividends for the past 25 years, and also Microsoft, that I expected to be the biggest dividend payer this year. There's also Asia, which people don't tend to mention, but Asia contributes to 1/6 of the dividend payouts globally, so there is potential. And yes, Asia has been hit by the pandemic and dividend payouts have been suspended, but the general trend is that the dividend payments to shareholders is increasing. So people follow me on this channel know that I don't follow trends, and I'm pretty okay being average and getting my returns over the long term. And to be honest, you can't really argue over historical rates of return over 5, 10, 15, 20 years. So I tend to invest in broad index trackers, and at the moment the yield is around 2.4%. That's fine for me. I take that and I reinvest that to buy more stock. I do have an ISA which I pick individual stocks. It's a little bit like the Roth IRA, except I don't have to wait until I retire to take the money out of this one. Yay! I tend to pick between 10 to 15 small cap stocks, and I limit myself to those, and I refresh those on an annual basis. Stock picking is generally a hobby of mine, so the serious part of my investing goes into broad tracker funds, which I don't expect to take huge risks on. I mean, I'm not a hot shot trader, am I? So let's not risk all of that. But there you go, there's my summary. I hope it was useful. Do leave a comment below, like, comment, subscribe. All the support that you guys can offer will be great. I'm a new channel, so yeah, see you soon guys. Cheers, bye.